Two words spoken at the height of a global banking panic ended 167 years of banking history. 4 days before the end, Credit Suisse's regulator had confirmed the bank had sufficient liquidity. On the morning of March 15, 2023, a journalist asked a simple question. A man in Riyadh was on Bloomberg TV. He represented the largest shareholder of one of the most important banks in the world. The question was, would his organization put more money into the bank if it needed support? He said, absolutely not. The man was not trying to destroy anything. His fund legally could not exceed 10% of Credit Suisse without triggering additional regulatory requirements. He was essentially saying, we cannot invest more even if we wanted to. But the market did not wait for the footnote. It heard the news and it ran. By the end of the week, Credit Suisse, a bank that had survived 2 world wars, the Great Depression, the 2008 financial crisis and much more, ended its existence as an independent institution, absorbed into a rival over a single weekend, in a deal engineered by the Swiss government under conditions that a Swiss court will later rule exceeded the government's constitutional authority. Credit Suisse ceased to exist, not from a lack of money, but from a lack of trust. And the difference between those two things is everything. The consequences reached pension funds, mortgage rates, and the cost of credit for ordinary households across Europe. Credit Suisse was not just a bank. Most countries have thousands of banks. Credit Suisse was something rarer, what regulators call a globally systemically important bank. There are roughly 30 of them in the entire world. Some examples are JP Morgan, HSBC, Deutsche Bank. The designation sounds like a compliment. It is actually a warning label. It means this institution is so deeply woven into the global financial system that if it fails, the damage does not stay contained. It spreads. Banks that lend it money take losses. Pension funds get nervous. And nervous money is a dangerous thing. Credit Suisse had been running since 1856. It had offices in 50 countries and assets worth over $500 billion, roughly equal to the entire annual economic output of Norway. And yet, its most valuable asset was none of that. It was discretion, the kind of place where serious money went to feel safe. That reputation was the product. Everything else was just accounting. Credit Suisse did not arrive at March 2023 in good health. It arrived damaged. The damage was not yet visible to everyone who needed to see it. The trouble had been accumulating for years. Each incident, taken alone, might have been survivable. Together, they were not. In 2021, a little-known investment firm called Archegos Capital collapsed. Archegos had been making enormous bets on stocks using borrowed money, a strategy that works brilliantly until it doesn't. And when it didn't, Credit Suisse reported losses of $5.5 billion in a single quarter. It was larger than the bank's entire annual profit in each of the 2 preceding years. The quarterly earnings call on April 22, 2021 lasted less than 30 minutes. The executive resigned 5 weeks later. Around that time, Credit Suisse was deeply involved with a company called Greensill Capital. Clients of Credit Suisse's associate funds faced losses of approximately $10 billion. Individually, these were scandals. Together, they became a pattern. Then there was the espionage incident. Credit Suisse hired private detectives to follow a former employee. The employee noticed, and the story became public. The chief executive resigned. Then his replacement also resigned. In 4 years, Credit Suisse went through 3. It was convicted in a Swiss court, the first major Swiss bank ever to receive a criminal conviction for failures in its controls that allowed a Bulgarian drug trafficking network to move money through its accounts. The court found Credit Suisse's compliance controls had been insufficient to prevent the activity. Each of these events was met with the same response: an apology, a restructuring plan, and an assurance that things would be different going forward. Spoiler alert, they were not. By late 2022, sophisticated investors were already quietly reducing their exposure to Credit Suisse. The share price had fallen by roughly 70% over 2 years. Clients were moving assets elsewhere, slowly at first, then with more urgency. The question was no longer whether Credit Suisse was technically solvent. The question was whether anyone still believed it was. At the end of 2022, Credit Suisse's capital ratios were above the regulatory minimum. It was solvent. And yet, solvency is not the same as liquidity. And in a crisis, that distinction is the difference between a bank and a corpse. Credit Suisse's assets had not disappeared, its credibility had. Imagine you own a house worth $1 million. If you sold it, you could pay off your mortgage and have money left over. Then you are solvent. But this month, your salary did not arrive. You cannot pay your electricity bill. You are perfectly solvent, your house is still worth $1 million. But you have a cash problem. And that cash problem, if it escalates fast enough, can destroy you, regardless of what your house is worth. Credit Suisse had the house. What it was running out of was cash, specifically deposits. Deposits are the money customers place with the bank. When trust breaks, they move it. When enough of it moves at once, the balance sheet becomes irrelevant. In the fourth quarter of 2022, clients withdrew more than 100 billion Swiss francs from Credit Suisse. That is roughly the entire GDP of Slovakia, withdrawn from a single bank in 3 months. In the first quarter of 2023, another 61 billion left. And then came the Bloomberg interview, and the 2 words, and what little confidence remained disappeared overnight. What happened next took place over roughly 72 hours. By Friday, March 17th, Swiss authorities had concluded that Credit Suisse could not open for business on Monday morning in any normal sense. The deposit outflows were too severe. The risk of wider financial contagion was too. 3 options were on the table. First option was to let it fail. That was quickly ruled out, particularly in a week when 2 American banks, Silicon Valley Bank and Signature Bank, had already collapsed, and markets were nervous. The next option was temporary nationalization. The Swiss law did not provide for it. That left option number 3, find a buyer. That would be UBS, Switzerland's other major bank and Credit Suisse's long-standing rival. UBS did not enthusiastically volunteer. Taking over a troubled institution means inheriting its legal liabilities, its problem assets, and its departing clients. No sane born wakes up on a Saturday morning and says, "We would love to take on someone else's problems this weekend." The Swiss government, Swiss National Bank, and financial regulator structured a deal to make it viable. 100 billion Swiss francs in emergency liquidity from the central bank and a 9 billion franc government guarantee against losses from Credit Suisse's riskier assets. UBS had until Sunday evening to decide. UBS acquired Credit Suisse for 3 billion Swiss francs, roughly half of what Credit Suisse had been worth on the stock market just 2 days earlier. The Swiss Federal Council passed an emergency ordinance that Sunday night, a new law written and enacted in a single evening, granting powers to bypass the shareholders' votes that Swiss corporate law would normally require for a transaction of this scale. No shareholders voted, no parliament approved. A deal reshaping hundreds of billions of dollars of assets was completed by administrative decision on a Sunday night, 3 hours after giving themselves the power to do it. It was, in the most literal sense, extraordinary. And then it got even more extraordinary. When banks raise money, they do so in layers, a formal hierarchy that every investor understands before committing capital. At the very bottom is equity, the money shareholders invest. Under normal conditions, shareholders are expected to absorb losses first. That is the price of ownership. Above equity sits a layer called Additional Tier 1 Bonds, or AT1s. These were created after the 2008 financial crisis, so that private investors, rather than taxpayers, would bear losses in a banking crisis. AT1 bonds pay higher interest than ordinary bonds because they carry higher risk. Investors who buy them accept that in extreme circumstances, their bonds can be written down. Under normal conditions, shareholders absorb losses before AT1 bondholders. Imagine you lend your friend money to open a restaurant. He also has a business partner who contributed with their own savings. If the restaurant fails, the business partner loses their money first. Only after their entire investment is gone do you, the lender, start taking losses. That is the principle. It had guided how investors priced AT1 bonds since the instruments were introduced after 2008. In Credit Suisse's rescue, the Swiss regulator departed from the hierarchy that AT1 investors have long relied upon. 15 years of assumptions were suddenly called into question. 16 billion Swiss francs of AT1 bonds, gone overnight, held by institutional investors, including pension funds, asset managers, and sovereign wealth funds. Not partially repaid, zero. Meanwhile, Credit Suisse's shareholders received 3 billion francs in UBS shares. The shareholders received something. The AT1 bondholders received nothing. The reaction from global credit markets was immediate. The Bank of England issued a statement within hours saying it would not replicate this approach. European regulators said the same. Prices of AT1 bonds issued by other European banks fell sharply as investors assessed whether similar outcomes were possible elsewhere. The immediate crisis was contained. Credit Suisse did not fail in a way that cascaded through global markets. The intervention achieved its core objective. The bank opened for business on Monday morning under new ownership. The global AT1 market is worth roughly $275 billion. Banks across Europe rely on it to meet regulatory capital requirements. Since March 2023, investors have demanded higher yields from these instruments, reflecting revised assumptions about how the hierarchy might be applied in future stress scenarios. Higher yields mean higher borrowing costs for banks, and those costs do not stay within the banking system. They flow through the mortgage rates, business loans, and the cost of credit for ordinary households. BAK Economics, a Swiss economic research institute, estimated that between 9,500 to 12,000 Swiss jobs were at risk from the combined banks integration. And then, in October 2025, Switzerland's Federal Administrative Court issued a ruling that received little international attention. The court ruled that Swiss Financial Market Supervising Authority FINMA's decision to write down the AT1 bonds lacked adequate legal basis. The contractual trigger for a write-down had not been met, and the emergency ordinance relied upon exceeded the government's constitutional authority. FINMA appealed. UBS appealed. The Federal Supreme Court suspended the lower court's ruling pending its own judgment. As of today, the AT1 bonds remain worth nothing. The investigation into exactly what happened in those rooms has been classified. The full results, including full testimony and evidence, will not be made public for 50 years, 20 years longer than the standard period for such proceedings. Here is what the public record shows. Governments and regulators have spent decades building frameworks for handling the failure of systemically important banks. Rules have been written, hierarchies have been established. In March 2023, a Swiss court later found that the process used did not meet that standard. Credit Suisse did not fail because it ran out of money. Its capital ratios were above regulatory minimums. It failed because enough counterparties, clients, and investors withdrew their confidence simultaneously. And in banking, trust is not a secondary consideration. It is the foundation. 167 years ended by 2 words in a week when markets were already afraid. The investigation is sealed for 50 years. Make of that what you will.